Well, hello, ladies and gentlemen. Welcome to today's webinar on how to lock in gains and smile through earnings. As you can see here, I've got a couple images of what we're going to share with you today and what we're going to hopefully be able to help you with your stock positions and as we head into earnings. So we see a standard stock here on the left at the top going into a position that can't lose heading to earnings. Even a position that was already protected going into a position that potentially can't lose and can profit in both directions as well. Well, welcome to the webinar. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options and at Radioactive Trading Today. What we're going to cover today is our opinion on the best way to protect your stock going into earnings, ways to potentially generate income, leave your upside open, of course, ways to potentially profit in both directions, and have a no risk, no fear going into earnings with a properly structured setup. Now, of course, why are you here? Well, you may want to forget about October. If you had stocks that were looking good at maybe a 7, 8, 10% gain from August or from July even, you probably gave most of that back between October 2nd and October maybe 20th, 23rd, or 29th. In addition to that, many stocks did take a dip. Some of them started to recover in the last few days as well. Now, you may still be at a gain. You may be able to small loss, or maybe you had some good buy opportunities and you picked up some stock around the end of October, October 20th, October 25th, as things started to turn around. But there are still a lot of quality stocks that have earnings coming up. I think Disney's been going out today, and there's many more that are coming up in the next 15, 20 to 30 days. So if you're holding onto a stock position with a small gain, or you're holding onto a position with a small loss and you've got earnings coming up, do you stay in the position, go through earnings and pray that you get the move that you want, or do you close out now and move forward? Of course, we know what can happen at earnings. Well, a lot. A quality stock we can see drop 20 to 30% from a unexpected earnings. Today we see TLND, KOP, and PYX, which is actually not related to earnings. That's one of the marijuana stocks there. But we see declines of 27, 26% all at the open. Of course, we see the opposite. We see stocks that can gain 22, 23% from earnings suddenly snapping up to the upside. And I just mentioned this here. A lot of investors, of course, say, well, you shouldn't trade an earnings play with a stock that has negative earnings. I tend to agree with that. It's just interesting today, these two smaller stocks here down at the bottom, Houghton Mifflin, HC, and X1, all had negative earnings in the double digits heading into their earnings reports today. And, of course, now they're back up 23%. All right, so what can we do and where might we be? Well, here's a position. We have a profit and we have earnings coming up next week. On November 1st, 2018, we could have gotten to Canada Goose, GOOS, at 55.78. At the same time, we could have also, I'm sorry, it's 55.78. If anyone's there, I know you all are there. William said hi. Can a few of you just check in and tell me that you're hearing me okay? I've got a Bob B who says he's not getting any sound. Jeffrey says okay. Thank you, Jeffrey. Okay. Jace says it's fine. All right, so hold on, everyone. I'm just going to answer Bob real quick. All right. Okay, thank you, ladies and gentlemen. I'm sorry, I appreciate that. Okay, so 11-1. At the end of the October decline, wasn't quite the decline, but after the decline, MACD crossed over and so forth. Goose is at 55.78. It's currently trading at 61.59 as of yesterday. So we have an unrealized gain of $5.81, or roughly 10.4% on the position. Earnings are coming out next week sometime, prior to the 16th November standard expiration. So as we discussed, what is possible? Well, anything really. We could see a surprise upside, a gain of 15 to 17 points on this particular position, almost a gain of 35, 36%. Sound unlikely? Well, it might be unlikely, but it is possible. We could see the large negative earnings like we saw in TLND as well and see a 25, 27, 30% decline. Many of us have probably suffered that situation where we're tracking a stock, we're in a position, or even we're in an option strategy on a stock. Stock has positive earnings, increases its future outlook, extended and beat all revenue and estimates, but it still declines 3, 4, 5%. Okay? We know that that's the possibility. So we got to be structured. We want to put ourselves in a position to where the earnings don't have a negative effect on us even in the worst case scenario, and we don't limit the potential for the best case scenario. So with that goose position, own it at 55.78. It's currently trading around 61.59 as of yesterday. What could we do to structure a trade? To sort of reset it. Do we close now and we simply take the profit? There's nothing wrong with that if we've met our goals. It's a 6-day trade. We've made 10.4%. We're probably not going to duplicate that every 6 days for the next year, but we probably met our goals. Nothing wrong with taking the profit. We could close half. Sell 50 shares of that stock. 61.95. That would lower our cost basis down to about 49.90 or so. Right, so now we have a much lower break even. You can set a 5% stop order or 5% below your purchase price. Even if the stock falls to 10% and drops another 5%, you're still essentially at break even. You didn't lose anything. To do that doesn't cost you anything. You could sell a call. Naturally, those premiums are going to be inflated with earnings coming up, so we could sell a call to hedge the potential loss. Or, hey, maybe we could buy a put to lock in gains. So just out of curiosity, you've got a stock that in 6 days is up 10.4%. You've got earnings coming up next week. What would you consider doing right now? Would you just close now and take that 10% profit after 6 days? Would you close half of it, lowering the cost basis? Maybe you could set a 5% stop, so we'd set a stop maybe even around our cost basis, right, at around 55.38 or so, or 55.78. So the stock would have to drop to that price, or maybe even 5% below it. It's about 52.50 or so. All right. Set a 5% stop. Would you sell a call to hedge the loss on the position, or buy a put to lock in the gains? Now I'm only going to leave this open for about a minute. We've got about 40% of our audience voting, so I'm just going to encourage you to vote. There's no wrong answer, really. Now, in my opinion, there's one wrong answer, but okay, so in my opinion, there's two. No, actually, there is no wrong answer because we don't know the future. Okay, so I've had the poll open for a minute, ladies and gentlemen. Let's close the poll and move on. All right, 17% of you would close now and take the profit, and there's nothing wrong with that. You have nothing to worry about. You've got your 10% gain. You're good to go. 17% will close half. That's good too. You've lowered your break even down to about 49.90. You need a significant drop in the stock for you to lose any profit, and if it takes off, you're going to make a lot more premium. You still have unlimited upside. No one sets a stop. Okay, that's rewarding. That's encouraging. 17%, of course, hedge with a call, sell a call against the stock. Why not? Reward yourself, taking that inflated premium, give yourself a lower break even, still leave some upside on the table for it. And 50% of you would buy a put to lock in a gain. All right, that's great. Now, when I said there really is no wrong answer except for one, and it's not really a wrong answer because we don't know the future, but the selection of what you're going to do is going to come down to your goals. All right, and there's nothing wrong with that. If your goals are met, you may close now, 17% of you would, and you'd be in a pretty position and no worries going into next week. 17% of you would sell half. Still a good idea. But of course, if I wanted to still hold the stock long term, if it pays a decent dividend, it's part of my core holding in my account, well, I might want to stay in it and not just close right now. Closing half, of course, we saw that lowers the break even. That looks good as well. But now we have a lower number of shares, but you still have a good profit if it jumps on you. You still might realize a loss if it drops 17, 18 points, that 23, 30% or so. Okay? No one said they would set a stop for free, and I appreciate that. Because think about how it would have worked on that TLND stock we saw today that was down 27% from earnings. The stock looked okay. Around the same time we're looking at Goose with a purchase price on November 1st. Could have gotten into TLND at 58. As of yesterday, we're looking at a nice 8.5% gain on the position. So I might have set a stop order around 58 around my purchase price. What happens with that stop order? Well, if the stock falls, as it did, at the open, drops down 27%, your stop is triggered, but they can't get you out at 58. They can only get you out at where the market's trading. And at the open, that was down to about 42, is it 44, but then it dropped down about 42, went down to about 38. So you might have been closed at $38, nowhere near. That's 20 points less than the 58 stop you set. Stop order is assumed insurance, and you can't control the exit price with these types of gaps. So no one said they would do that, and again, that impresses me. I'm glad to hear it. Now, nothing wrong with rewarding ourselves either. We picked a great stock. We had the right timing. Got in November 1st. We're sitting on a 10.4% gain. We do have earnings coming up. We're feeling good. We're feeling bullish. Let's reward ourselves. So we could sell. It's going to be inflated, right? We're going to have a high implied volatility. So we could sell the November 65 call. I'm still 4 points, 3.5 points above the current stock price and get 265. This gives us a potential profit of 22.3%. The stock's trading above 65. We get called out, make a good premium. Lowers the break even to 53. Not as low as selling half, of course, on the position, which took us down to about 49.90, but it does lower the break even. That's still a 14% decline from where we are today. But again, it does cap the upside above 65. That's quite all right. You're still looking at a 22.3% profit. But what if this goes up to 78? What if it goes up to 80? And it might be unlikely, and you'd still make your 22.3%, but then you'd be missing some upside. Why do I keep talking about this 17-point movement on the stock? Because last quarter, last time they had earnings, Goose did do that. Went from 45 to 62 at the open and closed at about 63, and then 3 days later it was trading at $68 per share. So it had a significant move. It's about a 40% move 5 days after earnings. So it has gone up 17 points before. Could it go to 78? Sure. Would you still make 22.3%? Absolutely. Would you miss out on remaining movement going forward up to 75, 78? Yes, unless you wanted to pay a lot of money to close the call and continue the trade. Might not be worth it at that time. You say, oh, well, I can always buy back in. Of course. Now you're buying back in. 75, 77, $78 per share. It's possible. We don't know if it's likely. Okay? But it did move that 17 points. It continued up to about 23 points after that earnings. It could also drop 17 points. And does this help us with the downside? No, it gave us that move to 53. That's only 8. Drops another 9 points, 10 points down. We're at a loss. That idea of that 22.3% gain is kind of thrown out the window. We're forced to manage it by selling premium that's not inflated over time to get back to break even. There's nothing wrong with rewarding yourself. 17% of you said sell a call. That's great. That is a great idea. Why not reward yourself? But we want to reward ourselves in a little bit better structure. So what is perfect? Well, we don't know because we don't know the future. If I knew after earnings that Goose was going to be trading up at $68 per share, I'd structure maybe a butterfly or something like that that would maximize the profit while still owning the stock. If I knew it wasn't going to move at all and stay at 61, well, selling the call would be a great idea. If I knew it was going to drop down to 47, why not sell the stock and just buy puts in general? Okay, so we don't know the future. We have a stock. And if our goals are to stay in it and cross through the earnings, what would I like to do? Well, I'd like to lock in gains to have no loss. Guaranteed. Not like the stop order, which is assumed insurance. I want a guaranteed locked-in gains. I want to reward myself. I want to generate premium on the position, take in some profit because I picked the right stock and it looks really good and the premiums look really good. But at the same time, I want to leave the upside open in case there is a massive surprise going forward to the upside. What I sometimes dub the perfect hack trick for locking in gains and heading into earnings. So what do we do? Step one, I'm going to buy a put with the 50% of you that said you're going to buy a put option. Absolutely. This will add to the cost basis, but the benefits are overwhelming. But you don't have to go in blind. Now, I know that the earnings are coming out next week. So we have a tool for you at Power Options called the Insurance Tool. And it's going to help you determine which put option would give you the best scenario based on your expectations and your goals. With the Insurance Tool, all you have to do is put in your stock symbol, put in your cost per share, and select your expiration month. And the system's going to show you which put options right now. We have a 10.4% unrealized gain. It's going to show me which put options are going to lock in the most profit. What does that mean? Well, if I bought this 9th of November 64 put for 260, remember the stock's trading at 61.59, so it's in the money, but it's only got 19 cents a time premium. I do increase my cost basis to 58.38, but guess what? I bought a 64 put. That means I'm guaranteed if the stock collapses, if the stock stays the same, we're guaranteed to make 9.6%, 95, 94% of the unrealized profit we have right now. But again, I wanted to mention to you that it still depends on your goals. Now, I'm showing you this is how the tool works, and we can look at it later with some of your stocks potentially as well. But this is not what I want. I want the 16th of November expiration because earnings are coming out next week, not this week. That's okay. Would have seen a lot more. I just didn't want to put it here on the screenshot. I saw all the November 16ths. There were many more. Which is the best? Well, that comes down to you. The Insurance Tool will show you all of the puts that you can purchase and your locked-in profit that's available. You can choose to buy short-term, which gives you the lowest cost, but naturally the nearest to expiration is probably going to be inflated slightly. But it'll help you lock in the most gain. I can go out a month or so to December, maybe to January, to lock in some gain, but have a longer time of guaranteed profit and further upside on the position. I can actually go further out. I could go to April with a 65 or maybe even the 70 put more likely, still have no risk, a guaranteed profit of maybe 1%, but now I can cross another earnings with no risk, can still collect dividends if the stock pays a dividend over that time, and I can still sell premium and do other adjustments between now and that next earnings cycle or through the next earnings cycle and beyond. Well, let's take the shortest. I'm going to take the shortest time frame that still crosses earnings, and I'm going to go slightly in the money. And why am I doing that? It's expensive. It looks very expensive. We have a cost basis on Goose of 55.78. One of the answers in the Insurance Tool is I could buy the 16th of November 65 put at 680. Well, the stock's at 61.95, or 61.95 or 62. It's only $3 in the money, but it's priced at $6.80 for 14 days. Why? Because of the implied volatility. Am I overpaying? Yes. But because I picked the right stock, look at the structure. My total investment is $62.58. The put gives me the right to sell those shares of stock at $65 at any time between now and Friday's expiration. So I have a guaranteed profit of $2.42. or 3.9%. Why didn't I choose the 60? Well, it was a lower price, I believe, at around 370, but it only locked in 1% of profit. All right, so it put us at a cost basis of around $59.40. Having the 60 put would have guaranteed a profit of $1 or so, but it was only, it was under $1, it was like 87 cents, but it was only about 1.6%. I'm going to go to this higher range, this guaranteed profit of almost 4% no matter what happens next. And if the stock gaps, if our stock does gap back up to 77, 78, or even just to 70, we still have more upside potential profit. And if we're wrong and it falls to 41, 47, or 49, the break even if we had sold half, we're still guaranteed a profit of 242 beyond the break even. Remember, just selling the call itself would have set the break even at 53. So you'd be at a wash. Here, we're still at a profit of 4% on the position. Of course, we didn't lock in the 10% by closing now, but I'm still in the trade. I can go through earnings with no fear and have a guaranteed profit. But what do we know about the hat trick? Well, it takes 3 steps. It takes 3 goals to complete the hat trick. So step 1, we want to guarantee profit. Step 2, reward ourselves. Just bought that 16th of November 65 strike put. It was inflated. Why not sell the 65 call we were looking at before? Get the same $2.65. This increases our guaranteed profit up to 8.5%. 80%, 85% of if we just close the position, take the 10.4% return. It creates a conversion because we're using the same strikes. It's a straight line profit and loss chart. Naturally, I wouldn't do this. Why? Well, I wouldn't do this by itself. If I'm comfortable with an 8.5% return guaranteed, you're right. I would have just closed the stock today or yesterday and taken the 10.4% return, and I've got that. But this is the second step. We're going to reward ourselves, and we could sell the 70. We could sell the 75, give ourselves more upside. There's different ways we could do it. But we're going to maximize it by taking the 65, same strike as the put we just bought, in this case, guaranteed of 8.5%, but there's no further upside. I wouldn't do this. I would have just sold it now and taken the 10.4%. And that's where we come into step 3. What can we do? Step 3, how can we leave the upside open? Well, I could buy more stock. Well, that's going to be expensive, and it takes on the risk, doesn't it? The put I bought only protects the shares that I already own. If I buy a few more shares or 10 more shares, put another $600, $700 or so, well, if the stock falls, I lose that. Okay? How about a long call? Good, but it costs money. But then again, we did just receive a fair amount of money for rewarding ourselves in step 2. So let's buy to open a further out of the money November 70 call for $1.25. Now what have we done? Now we have the hat trick. We've got the 65 put locking in gains. We rewarded ourselves and generated premium by selling the call, the same expiration cycle in this case, and then we bought a further out-of-the-money call. Now this guarantees us a profit of 6.2%, 60% of what we have right now if we sold to close it. But knowing what this stock does, if it does gap up that 10, 12, 15%, or even 10, 12, or $15, we have an unlimited upside. We have a guaranteed profit of 6.2%. If the stock stays, we're still good. If goose gaps up, fantastic. And if it tanks, I still make 6.2%. I didn't match the 17% that closed out now and took the profit, and that's fine. But I can stay in this position. I can go through the earnings with absolutely no fear, the potential for that high reward, a guaranteed exit, unlike a stop order, and even if I'm wrong, I still make 6%. Now, why do I keep saying I'm still in the position if all these expirations are the 16th of November? So what happens if the stock falls to 50? Okay, well, come Friday, November 16th, or maybe even Thursday after earnings, my 2 calls are going to expire worthless. I can sell to close that 65 put for $15, which does what? Lowers my entire cost basis in the position back down to about $46. I'm still holding a $46 stock. It's trading at 50. I'm still at that profit of around $400, and I can continue the trade going forward. The put doesn't mean you bought the put. You didn't sell the put. If the stock tanks, that gives you the right to get out. But it also goes to intrinsic value. You can sell to close it, knock the cost basis on your stock down, and continue to trade. So even though I've got a short call here at 65, for November 16th expiration. Even if it gaps up to 70, what happens? Let's say it goes to 72 or 73. Well, I may have to deliver shares of stock at 65, but I have the right to buy it at 70. What is this? What is this combination here of selling a 65 and buying a 70? It's a bear call spread. But it's done in the context of owning the stock, so I didn't have to put up any margin requirement. Broker just sees this as a covered call, no margin required, with an extra long call that we were paid to own. Yes, I paid $1.25 for it, but I collected $2.65. So it's essentially a free long call. And if the stock does gap up, okay, so I may have to buy shares of stock at 70 to deliver at 65 and miss out on 5 points, or get assigned on these shares at 65 but buy back at 70 and just miss 5 points in order for the stock to move up $10, $12, $15. That's a fair trade-off, and it gives me the exact structure I want to complete all 3 of my requirements. So to lock in the gains, a guaranteed profit by buying a put, you can use the insurance tool on power options. All you have to do is put in your stock symbol, put in your cost basis, select the expiration month, and evaluate which put gives you the best guaranteed return for your goals. Now reward yourself. Also on the insurance tool, you can evaluate selling a call on the position. We could use the insurance tool, which shows us calls to sell, and then we can look at the profit and loss chart to complete the hat trick, buying that further out of the money call to see the structure that we want. And based on your goals and your needs, it doesn't have to be the same expiration. I just showed you what was possible and what I would do going through earnings potentially with this position. You could look at that insurance tool and decide you want to buy a December put option to maybe lock in 4 or 5%, but then sell the November 16 call and buy the November 16 call and just manage that call side afterwards, but you still already have the put in place, and you can choose then how to keep managing the position, making adjustments or not. Now there's lots of possibilities. Right? I showed you other structures, screenshots at the beginning of the webinar, and I also showed you one that you could potentially smile through earnings with no risk on the trade. But what if we were already in the properly structured protected position heading into yesterday when the stock was at 61.59? Could we still benefit from that transaction? Absolutely. So we're going to take a look at some few things here, and I'm going to encourage anyone. If anyone knows, well, I hope you know, but if anyone has a stock that's up in price, even if it's only 3% or 4% from where you got in, and you've got earnings coming up, send me the stock symbol in the question pod. And of course, give me the original cost basis of your position as well. And we'll take a look. But for the moment, we're going to take a look at something else. All right, so I'm going to head over to Power Options right now. There we go. All right. And what I want to do is I'm going to go into the portfolio. And what I have set up for you, and we're going to follow up with this next week as well. What do we see that I have here? This is actually, one of these is incorrect, and I apologize for that. I had an errant keystroke. But yesterday I entered it. Well, here's the 100 shares of stock at 55.78. Here's the 50 shares with the adjusted cost basis. It should be 49.99, not 24. It was an errant keystroke. I apologize for that. But that's what would have happened if we would have sold half at that time for the 61.59. Here's that 16th of November 65 put we just found with the insurance tool. And down below here we see the covered call as well. Now, here's something interesting. The actual position I'm in that Fusion subscribers at Radioactive Trading see is I do have a heavy risk on this position. I have a cost basis on Goose of 50.93. After a few months doing income methods, other adjustments, I've been in it for a few months, but I have a cost basis of 50.93. But I have the January 55 put at 8.70, still 71 days to go. So let's take a look at the profit and loss chart for my married put position as of yesterday. It does have a 7.8% risk on the position. I've let it run as much as it could, the recovery after October, so it was up at 61.59 we saw the other day. It's a 61.09 today. January put, 55 put, kind of expensive, but it gives me a 7.8% risk. I don't want this going into earnings either. I'm much happier with this structure, believe me, than I would be a long stock or a covered call heading into earnings. So I could only lose 7.8% even if the stock falls 27, 28, or 33%, which we've seen in the past. So what could I do now? Well, I showed you that we could buy the November 65 put, and it looked expensive at 680. I paid 870 for this position, but it's not at zero. Even though the stock's at 61.09, this January 55 put still has value, and it's reasonable value as well. So what might I consider doing now? Well, let's go to January and take a look here. So we're using the custom spread tool and power options. It's about 370. I believe I got a better price yesterday. So I'm going to sell to close this put. Yes, I lost 5 points on it, but the stock's gained more than $10 from when I had this purchased at 870. So still a fair trade-off in this position to have the guaranteed protection in place. So I'm going to sell this at midpoint at 370. What does that do? It takes my cost basis to 55.93. Pretty much the exact same price I could have gotten into on November 1st. I use that as an example to show where you might be with your positions. But if I sell to close this put, I'm pretty much at the same scenario we were at. Okay, so let's say first I do this. I sell this put, restructure my trade. Now I'm in a long stock of 55.93. What can I do now? Step one, let me guarantee profit. So I could go to the insurance tool right now. We'll just walk through that. I'll go to the insurance tool. I know my cost basis on Goose is a little higher than our examples we were seeing, but I'm going to put in 55.93, excuse me. Let's just hit calculate. So now I choose all expirations. We see some deep in the money puts here, okay, that would lock in the most guaranteed profit, a 9.5% unrealized gain. I have puts out to January to December, closer in time December, 2.3%. Let's just go shorter term. Let's go to November. Okay, so we see the November 9th one comes in, and then now the 16th of November ones come in. Different numbers, 5.7% at the 70, and the 65 put here at 3.8%. Well, that's where we were before, wasn't it? So I'm just showing you how this tool can be used. Now, if you wanted to go to December, but sell shorter term calls, or complete the process, I just change this to December. It's going to be a higher premium, not going to lock in as much gain. But hey, this is interesting. 7th of December, 29 days out. I could lock in 2.3%. Guaranteed return going into earnings. But I want to sell a November call. Probably the 16th. Could be the 23rd, but let's go take a look here. So I'll just change that sell call month to November. And now it's going to show me the monetary values and the calculated return, sorry about that, of just the combinations. You could do a 14th of December. There it is, the 7th of December 65 put with the November 65 call 8 days away. We've got a locked-in profit of 7.7%. Okay, it's not quite a conversion because I have a December put now instead of the November. What would that look like? It's going to look like a little bit, sort of like a calendar collar. So let's just go to the profit and loss chart real quick. There we go. So this is still an interesting scenario. We get 286, now 287, 288 for that 16th November 65 call as Goose is continuing to go up. But we've locked in the profit there. We have a guaranteed profit of 7.7%, and then that max peak right there at about 17.7. But then what can I do real quick? Let's complete the hat trick. We sold the November 65. What would this structure look like now? We bought that further out of the money call, completed the bear call spread. Again, it's going to be about 140 to buy the 70. 138 gave us a midpoint. And that looks kind of interesting, isn't it? I've got a little heartbeat on this position, a guaranteed profit of 5.3% with unlimited upside going forward. So essentially, what you're seeing here is sort of an interesting trade that can be done. Not what I actually did, okay? What I actually did is took advantage of what we call a couple different income methods from the original position yesterday for the Fusion subscribers at Radioactive Trading. I just don't have that open now. There we go. But what I did is I did sell to close my January 55 put. No, I'm sorry, there we go. So let's go back to the original position there. Their January 55 put. Had that risk of 7.8%. What I did, there we go, is I sold to close that for 385 and I bought the 60 for 425. Either selection is good because it depends on your goals. And then we completed the hat trick by selling the 65 call for 250, buying the November 70 for 125. This does give me a guaranteed profit on the position heading into earnings with the unlimited upside that we already saw. So, two ideas here. For those of you that are just trading stock, have never maybe seen this concept before, have just played around with buying a put occasionally on your stock and just saying, yeah, let me go to the next available earnings, the next available expiration right after earnings, and let me just buy the at the money or the out of the money put for cheap. You can check out the insurance tool here at Power Options. Of course, anyone can get a free trial at any time just using name and email address. You can go right under Marry Put, go right to the insurance tool, plug in your stocks, your cost basis, and toggle around with some of the expiration months to see which put would give you the best locked-in profit as you head through earnings. The 16th here, different ones that we have to ignore the 9th, but the 16th one's there as well, to lock in the profit, and then we complete the other 3 steps as we go through earnings. So that's what's possible. That's our approach for using it. In this case, when you've got a gain, or even if you have a small loss and you want to make sure that you don't take a further loss, then what is possible and what we can look to do is satisfy all of the needs at once. You can complete the hat trick. The techniques we discuss at Radioactive Trading and the Power Options tools, the insurance tool and the custom spread tool, and even just tracking it in the portfolio tool, it's going to help to show you how you can lock in gains that suit your needs. Reward yourselves by generating income and then completing the hat trick and leaving the upside open. You can also set up a smile through earnings. It's a way to profit in both ways. So we can go back. Let me go back and show you an example of that real quick. Have a low risk or maybe no risk where you can profit in both directions. Let's just go back to the initial position that I was in yesterday. Remember, we have Canada Goose at 50.93 roughly was the cost basis. Had a January 55 put for 8.70. That does carry a risk with it. Now, I'm expecting, again, based on your needs, this is another idea, this is another concept. What I can do now is, same as I did before, I can sell that January 55 put. We'll get about 370. That'll take our cost basis down to 55.93 as we showed. And now what I can do, I can still buy that same November put, the 60, okay, or the 65. Let's just use the 60. It's going to cost me 390. What if I buy 2? Now I've got a position where, sure, I'm still carrying a little bit of risk here, but you see, if I went further out, if I went to December, or even if I bought an extra one out to January, going through to 11/14 the day after earnings, there's no chance, there's a small chance of loss. It's the smile through earnings, and both upsides are open. Now, it's not going to look the same, but what if I just bought an extra January 55 put in this case for 370? It's not going to give me what I want. I'd probably want to look for a 60 or maybe the 65. But here, if I just bought another put, these are out to January. I'm still carrying a large risk. But on earnings, on or around the 14th or 15th, the halfway point, we've got a smile through earnings. I still can make a potential of, $300 or so. That's right around that 4%. But if it really gaps up, I still have unlimited upside. And if it really gaps down, we're smiling through earnings with no chance for a loss on the position, a guaranteed profit in either direction. That's the smile I was alluding to. There's different ways to structure it. I chose not to do it in this case. In this case, what Fusion subscribers yesterday saw is that I essentially set up the hat trick I showed you today. I found the near-term put I wanted that goes through expiration. I sold the call to reward myself, and then I bought that extra call, which I essentially now own for free because it's a lower cost. So I have a guaranteed profit to the downside, unlimited upside potential profit, and a really good profit anywhere between. In other words, anywhere between where it is now and 70, the upper call strike, I'm still making a reasonable profit in all of those scenarios as well. Okay, so that's how we can satisfy all the needs of owning a stock with a small gain, a large gain, or even a small loss, to where we can protect the position better, reward ourselves for picking the right stock and get some income, still leave the upside open. There's other structures we can go into earnings with a smile, no risk to either side, but potential for extra profit in either direction. The smile through earnings to profit both ways. And I showed you today what you could do with your stocks. I also showed you that it's possible with already having a limited risk structure in place to cancel all of the risk on the position and still complete the hat trick. No, sorry, folks. Now, the full technique of that initial structure I was in and the adjustments that I use today are actually all income methods. What I used in my goose position, they're all income methods of the 12 different income methods that are discussed in the blueprint. You can start from a no-risk position going forward, then as you approach earnings, you can cancel all of the risk because you still have value in the initial put structure that you had. Well, the blueprint's the only place where we discuss all 12 income methods. If you want to see that in action, what you should do now is head over to radioactivetrading.com/iridium. And if using that link, what you'll be able to do is get the 5 bonus offers we have right now. If you decide to pick up the blueprint, you'll get a quick action guide to help you get started faster. We have 6 Mastery Series videos that go along with the blueprint. You'll get the first one for free. It's an $89 value. That Fusion subscription I was talking about, where I post my trades and Ernie posts his radioactive trades, you can get your first month for only $10. It's usually $69, so it's a benefit of $59, not $79. And you'll also get a free month of power options where you can test out the insurance tool, start using the portfolio tool to track your positions and evaluate rollout opportunities, as well as put in your own stock to complete the hat trick. So that's radioactivetrading.com/iridium. What is inside the blueprint? Well, it discusses the proper structure of that initial setup I showed you from the beginning that I was in with Goose. There's a full chapter on bulletproof from the beginning. If you already do have a stock that has a gain in it, how to work through that insurance tool. Of course, I can help you with that too. And we saw that today, but how to use that insurance tool, what we feel is the proper put to select based on your goals and your needs. Each income method has its full chapter. Income method number 3, called the Bulletproof Vest, that's one that I essentially used yesterday on the Goose position. Income method number 6, that bear call spread, to reward ourselves with premium but leave the upside open in the proper limited risk structure. And income method number 12, there's different ways to structure it, and that discussion is also in the blueprint, and that's the structure that allowed me to smile through earnings if I wanted that direction. Head into November with no chance of risk using the January put I already owned and an additional put so I can profit in both directions, but at November they'll still both have a lot of time premium so there's no risk after earnings of taking a loss. And I can still choose to manage both legs, manage all legs, or just liquidate the position as well. Well, if you want to see how the insurance tool can lock in gains on your stocks, just try Power Options for 2 weeks. Just go to powerop.com/RAT, put in your name and email address, and you'll be able to access the insurance tool, the portfolio tools, and of course that custom spread tool that we showed today to help you evaluate adjustments, roll out opportunities, or completing the hat trick on your position. You can also send me an email at any time to support@radioactivetrading.com. And as always, you can give us a call here at 302-992-7971 during market hours. I hope you enjoyed today's presentation and found it very useful. I look forward to seeing you all and to seeing your questions later on and seeing you all next week for other webinars going forward on the limited risk techniques and the tools on power options. This video was recorded. It will be posted today, and I will send you all an email when the webinar is available in the archives. Well, take care, everyone. I hope you find this useful again for your trading and that you start maybe implementing the 3 steps we showed today to help you guarantee the profit, reward yourself for picking the right stock, and leave the upside open as you're heading into earnings on your stock positions. Take care, everyone. Happy trading. Good night.